Here are Alex, Amy, and Adrian. They are three friends. In this video, we are going to present one of the four famous financial statements, the balance sheet. The balance sheet records the financial position of a company at a certain date, which could be the 31st of December, but also the 31st of March, the 30th of April, or any date you want according to the financial status of the company. The balance sheet is classified into three main sections: assets, liabilities, and owner's equities. To remember these three subsections, you can think of the nice Mediterranean plant, the aloe. It is the acronym for A for assets, L for liabilities, and OE for owner's equities. What are assets? Assets are items that are owned, have value, and can be turned into cash, such as bank accounts, cars, property, and machinery. What are Alex's assets? Alex owns a number of things in his personal life: his tennis racket, his gaming console, a nice little red car, and the cash he received from his parents at Christmas.
For Adrian's company, the assets are classified into several subsections. The first section is the current assets. That means assets which can be converted into cash within 1 year, such as cash, obviously, and accounts receivable, also called AR.
When the boss sells computers on credit, an account receivable is recorded in his books, which means that the company owns the right to receive money from the customer at a future specified date. The accounts receivable on the assets of the company increases. When the customer sends the money and makes the payment, the company receives the payment. That reduces the company AR and increases the cash of the company.
Next, we meet the long-term assets such as the land, property, and equipment like tables, chairs, computers. Then you have another subsection called intangible assets such as goodwill and patents. The other assets are a kind of global section where we can find the deposits. So, when you add up all of these subsections, that will give you the total of the assets.
What are liabilities? Liabilities are what is owed. A loan to purchase an asset is a liability. What are the liabilities for Alex? To buy a car, Alex subscribes a bank loan. The car is an asset. The loan is a liability.
Let us see now what are the liabilities for Adrian's company. On the top of the liabilities, we find the current liabilities that he will pay off within 1 year. Accounts payable is used when the company purchases items for everyday use and pays them on credit.
So let us imagine that the boss goes to a store to buy supplies on credit. That creates an account payable on the company's book. When the boss makes the payment, the accounts payable decreases. Please don't get confused between accounts receivable AR and accounts payable AP. Accounts receivable means a company is going to receive cash. It is an asset. Accounts payable focuses on the word payable. It is a liability.
Then we find the wages payable. That represents the amounts owed to employees for works completed but not yet paid at the date of the balance sheet. The next subsection presents long-term liabilities. For example, loans. Here is the accounting equation. Assets equals liabilities plus owner's equity. There are different accounts that make up your stockholder's equity. The common stock, or shares, represent the money the investors give a corporation in return for ownership and entitle the shareholders to receive dividends. The subsection retained earnings registers the company's profits. If we look again at the equation, the stockholder's equity would be the difference between the total of the assets and the total of the liabilities. It is the net worth of the company.
Now let us look at Amy's business. She is starting a new business. She goes to the bank and gets a loan. On the balance sheet, this loan is a liability as it has to be repaid to the bank. The cash received from the bank is an asset. Thus, the balance sheet is balanced. With this cash, Amy buys a new computer. This is an asset. The investment increases and the cash decreases. As Amy sells cakes to restaurants, her profits are recorded as retained earnings in the owner's equity section. The cash from these profits is recorded in the assets sections, and the sheet remains balanced. In this video, you learned what is a balance sheet and what are assets, liabilities, and owner's equity. In the following weeks, I will teach you what is an income statement. Thank you and see you soon!